Hi, and thank you for watching us here at Tax Talk UK, where we talk about all things tax and consider other important aspects of working for yourself, being self-employed, running a small business. Today, I'm going to talk about claiming VAT on items prior to registration and the rules surrounding that. Before I do, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information, as well as being able to access other information that we have on a whole host of different topics, all aimed at supporting you in your self-employment and all loosely catalogued in our playlist section of the YouTube channel. So back then to VAT registration and what happens if you had already paid VAT before your registration. So this may be for a number of reasons. Perhaps you have traded for a little while before you were required or decided to register voluntarily for VAT, or perhaps it's just a sort of organisation type thing, and your VAT registration didn't coincide with the start of your business. But whatever the reason, there are rules in place that do allow you to claim some of your purchase VAT if certain conditions are met. So loosely the different scenarios are and the different rules come within goods that you've purchased. So here we're talking about any perhaps your materials, stock, or assets, office equipment, anything that you actually have. So goods would really encompass tangible things that you can see that you have. And then also separate rules apply for services. So this would be things that are helping you to operate your business, but you can't physically see them. So at the time that you register for VAT, if you have goods, then you can claim for 4 years preceding the VAT registration date. So when I say registration date, that is the effective registration date, not the date that you apply for registration. And for services, that is 6 months preceding the registration date. So what this effectively means is that on the date of the registration for VAT, you would carry out a stock take for a start. So you would look at any materials or cost of sales that you have purchased ready to incorporate into your work, but that you haven't used. So you still physically got them. So we refer to this as being on hand. So items that you have on hand at the date of registration. So you would look at your stock and you would write a list of all the items that you physically still have that you haven't used. You would look at your assets, any sort of like equipment that you have, any sort of machinery, and you would be looking at the items that you've purchased within the 4 years. So if you purchased something 5 or 6 years ago or more, then that wouldn't go on the list. And then you're just looking at anything that you physically got that you purchased for your business, that you purchased in the 4 years preceding the registration. And then you would look for the invoices for those to see how much VAT that you paid at the time of the purchase. And then you would be looking back probably in your accounts for the previous 6 months to look at services that you had paid. So once you have compiled this list, so you have your list of everything you have on hand, so your stock, your assets, any equipment that you have that you purchase for your business within 4 years of the date that you are actually registered from, so the date on your certificate, and services for 6 months prior. So those items you will be able to include in your first VAT return to include a claim for that VAT. They're known as pre-registration cost, sometimes called Regulation 111, which relates to the VAT laws that we are governed by. But regardless of the terminology, the rules are as they apply. So that's four years for physical goods and 6 months for services. So one of the questions that is asked from time to time is, what if you are a sole trader and you change your trading style to a limited company? Does that affect your ability to claim your pre-registration costs? And generally speaking, you still would be enabled to do this under the rules, as long as at the time that you purchased the goods, they were for business purposes. You're still trading in the same line of work, and that the limited company did pay the sort of your sole trader business for the goods. Then that would be okay to still claim those costs with the general rules applying. Now, one of the things that I mentioned there that does actually apply to everything is that at the time that you purchased the goods or had the services, that was for business use. So at the time, so if you have an asset, for example, maybe a piece of equipment that you are using for your business. Now, it must have been purchased with the intention of being used for business to be able to be included in your pre-registration costs. So that means that, say, for example, if you bought something for your own personal use, perhaps a camera, for example, or some equipment that you now have decided to go into business using, but at the time you purchased it, it was for personal use, and then you started running a business, or you decided that it would be useful to use that equipment in your business, and effectively you sold or transferred the item into your business, then this would not be able to be included in your pre-registration cost, because at the time that you purchased it wasn't for business use. So there's in terms of actually compiling your list of your pre-registration costs and things that you can claim the VAT on. There's a variety of ways that you can do this. In theory, you would, as I mentioned earlier, you would carry out a sort of a full stock take, a full review of your asset register to check the items that you have physically on hand at the date of registration. But in reality, it's likely that we're not physically going to be doing this on the date of registration. So you do need to keep some sort of record on the date of registration to enable you to do that retrospectively. And of course, you should do it as soon as possible, because then the more accurate it will be, and the more you will ensure that you include all allowable costs in that first claim. So in terms of how you actually go about making that claim, well, all of those items would simply be included in your first VAT return. Now, one thing that you need to be aware of, if some of the pre-registration costs fall in the same accounting period, so i.e. you've not finalised your year end for that, then in your software, you would just simply include those items with the appropriate VAT. But just be careful to ensure, because different software works in different ways, just ensure that it is pulling through those items to your VAT return before you spend a lot of time going back and doing that. If it isn't, or if they relate to previous year, then you will need to make adjustment in the accounts. So you would effectively need to contra the initial purchase of the amount with no VAT claim, and then offset that against the net and the VAT, if that makes sense. One thing that's important to remember, that people can sometimes overlook, is that say, for example, if you bought something 2 or 3 years ago, so it's within the four years requirement to be able to make the VAT claim. Now, let's say, for example, that you paid £1,200 for something which was £1,000 plus £200 VAT. Now, when you're not VAT registered, your actual cost in your accounts, your allowable expense, is the full £1,200 because you're not reclaiming the £200 VAT. So therefore, the full cost to your business is the £1,200. When you're VAT registered, we're only working on net figures within the account. So your allowable expense is the £1,000 because the £200 VAT you're getting back in effect within your VAT return. So it's not actually a cost, and so only the £1,000 would be the cost. So you can see here that if you have originally claimed £1,200 as your cost of sale, but now you're reclaiming that £200, effectively in the current period, you are now up by that £200 because you're getting that back. So that will be accounted for, and in effect, although it's a simplified way of looking at it, in effect now that £200 becomes taxable. So there will be an impact on the next tax calculation for the period that ends in which you registered, and obviously the amount of VAT that you claimed, the volume will obviously impact the tax. So to summarize, at the point that you register for VAT, you are able to claim VAT on items that you bought for business use within the 4 years preceding the date of registration, the date of registration being the date on your VAT certificate, and services that you have used within the 6 months preceding the VAT registration. If you incorporate, then because a company can't actually be registered for VAT until it's incorporated, and so inevitably there will be some, even if you go straight into trading as a limited company, there will be some costs that you will have incurred that you've paid for maybe personally, but also in the event that you're a sole trader and you are changing your trading style, then the rules can still be used in order to claim that. And in order to actually facilitate the claim, you just simply include those on the on your first VAT return. So thank you very much for watching. I hope that this is helpful. And as I mentioned earlier, please do subscribe to the channel. If you found the content useful, then please do like the content. Please remember that the like applies to the content and not to whether you like the tax or not. Thank you very much for watching. Goodbye.